Hi, I'm Patu from freefincal, and today let's talk about how much return should I expect from equity. This is based on a question asked at Facebook group Asan Ideas for Wealth, and you can imagine that this is a normal question any new investor would ask while investing in equity. And the truth is, if uh, they knew the truth about the answer to this question, most people will not be so enthusiastic about investing in equity. The contents of this video is nothing new. I have talked about this in several of my videos, but I thought, in the hope of reaching a new audience, I'll try and talk about this again. Before I begin, a couple of things. Let me come to this. Today, Chandan Singh Padiyar, SEBI registered investment advisor, had talked about the truth about ads which guarantee 8% returns from LIC and schemes closing spoon. That's the scarcity marketing that everybody employs. It's a very good article. You can have a look at that. And yesterday, I had talked about what investors should do with respect to the Vodafone idea. Bond downgrade and the possibility of default. Please do check them out. And also a much more detailed uh, discussion on the returns and risk of Sensex using long-term charts has already been published. This is a fairly old article. When did I do it? This is January 2018, I think, yes. So more than a year ago. So please have a look at that almost too. So what I'll be talking about now is just a small snippet of this, but it's a very key snippet. And I think this is how I should be opening the talk on at Bangalore on December 8th with this very slide. So let's get to it. So the truth is that nobody knows how much return one can expect from equity. This is the truth. But put yourself in the shoes of a sales guy. If you told the truth, nobody will buy mutual funds. This is the simple fact. Nobody knows how much return one can expect because India is continuously changing. We have Sensex data available from 79, yes. What India was in the 80s, it was not in the 90s. What it was in the 90s, it was not in the 2000s. Same as 2010s, now in the next decade. So India is continuously changing. India up to the 90s, it was more, it has a strong communist leaning. It was a closed country, and then it opened up. Everything changed. We had scams, we had crashes, we had recessions, all sorts of things, and things are continuously changing. And we cannot assume that the past would reproduce in future in terms of returns, but at least in terms of risk we must expect it to be as risky, and it was quite risky, and you will know what I mean from that. So what you see in the pink line here is 5,641 15-year data points from 1979 of the Sensex price index. I have increased the y-axis by 2%. I have added 2% because of the dividends. Typically, the dividends are about 1-2%. We can't assume 2% would be the dividends in the 80s and the 90s. I don't think the companies would be that wealthy to give away that so many dividends instead of reinvesting it back. But still, we will give the benefit of the doubt and just add all the returns by 2%. This is the price index. The total return index is not available for such a long history. I have done this many times. Like I said, it's only meant for the newer audiences. So you can see there are 5,641 returns. Now tell me, what is the return that you would expect for the next 15 years if you look at this? I mean, you can't say on average I can get 15, but this is the kind of bullshit that people talk about. They have they don't even know when to talk about average, and they say, look at the graph, it's not on average we can expect a 15%. No, and this kind of stupid comments, it's so annoying. You don't know what you would get because the lowest return is about 8% there. Include adding that 2%, it's still only about 8% or so, somewhere here. The highest, it's 20 to 24%. I can argue that it has come down over time. You don't know. It's simply potluck. I mean, you should count yourself lucky if you get a double-digit return by just tracking the Sensex or the Nifty. just very close by. So that's over 15 years, and this is 4,386 20-year returns. And again, you can see even over 20 years, it's about 9-ish, 9%. Remember, this is before tax. So you can argue that the graph is heading downward. You can argue that I don't know what return to expect. So the point is that it is better to be on the safe side and expect 10% return before tax or after tax. I don't know. Maybe it's better to on the safe side assume 9% after tax and 10% before tax from large caps at least. But then mid caps will give more returns. But then small cap, these kind of stupid statements you will always get. I mean, people are they don't want to manage risk. You should be optimistic about risk. You should not be optimistic about returns. I don't know how. I mean, again, they just look at, please, if you want to talk about mid caps offering more or small caps offering more, go and see, go and compare the small cap indices with mid cap indices, and over a long period you will understand how bad they are. So you just can't assume that they will, and I don't think there is any return that you can expect. The only problem is that when you want to do a goal based calculation, you must have some return to start with, and that return is better to keep as low as possible so that you can minimize the possibility of disappointment. And anything you get even point not 1% above that, it's you are happy and you consider yourself a success. And that's the only way to plan with equity. You assume that past risk will be reproduced at the least, at the very least. You don't expect the median return or the average return from the past. You expect the lowest return from the past. You prepare for the worst, and you pray that it's not the worst at the very least. You don't need to pray for the best. That's a little too optimistic, but you must certainly prepare for the worst. And my humble suggestion is, please do not expect more than 10% from all equity combined in future. Otherwise, you will run the risk of taking. I mean, you have to take on more risk, and that will be a problem. Of course, when you expect only 10%, you have to invest more. That is all right. Please don't try to compensate in terms of returns because you can't invest more. That is just stupid. Try to increase your income and expect less. So that's what I want to say. Catch you later. Bye bye.